Welcome to This Explainer. Okay, let's dive right into this, because right now we are witnessing an absolutely massive historical battle for the new monetary order. On one side, the oldest store of value known to humanity, gold. On the other side, the modern digital contender, Bitcoin. For decades, the global economy hummed along on a very specific rules-based structure, right? It constantly expanded debt to grow GDP. But as that debt literally explodes and starts outpacing economic growth itself, well, that old system is cracking. Money is actively searching for the safest, most neutral asset completely outside of that traditional system. And as we're about to see, the asset that's currently winning this massive wealth rotation, it might actually surprise you.
Now, this brings us to a massive, really fascinating paradox. Think about it. Bitcoin was quite literally born into this era of endless money printing. Because it's digital, it's portable, and it has a strictly finite supply, a lot of people naturally assumed it would absolutely crush everything else, including gold, when the traditional system started to show stress. But as our source material points out, that isn't exactly what's happening, is it? Gold is breaking out to new, unprecedented highs, while Bitcoin, well, it's actually been losing value relative to gold. So we have to ask the obvious question: if the world is really losing confidence in U.S. Treasuries and the U.S. dollar, why is the highly anticipated digital asset of the future getting left behind right now?
To answer that, the source uses an incredibly helpful analogy from physics. Think of the markets as being driven by two totally distinct forces. First up, there's the macro force. This is basically like the theory of general relativity, or gravity. It's slow, it's structural, and it dictates the movements of massive things over long periods of time. We're talking global debt or shifting world orders. Then, you've got the technical force. Think of this as the quantum mechanics of the financial system. It looks at the highly granular moving averages, the support levels, and the chaotic short-term, cycle-driven price action. So right now, the macro force perfectly explains gold's steady, massive rise, while the technical force, that's what we need to look at to understand Bitcoin's incredibly volatile, short-term action.
Section 1. Gold and the macro force. Let's look at the massive, slow-moving structural gravity pulling global capital toward gold right now. What's truly wild here is the sheer scale of the macroeconomic evidence. The macro force argues that hard assets should be winning, and the data absolutely backs us up. Global sovereign debt is exploding, and I mean exploding, significantly faster than actual economic growth. To put that in perspective, U.S. government debt relative to GDP is at its highest point since World War II. But perhaps the most telling piece of evidence here? Central banks. The sovereign Tier 1 nations of the world are actively choosing physical gold over traditional assets like U.S. Treasuries. They are buying physical gold at the absolute fastest pace in modern history. They're clearly looking for a neutral, safe asset that exists completely outside of any single government's control.
And this brilliantly illustrates an absolutely crucial concept drawn from financial analytics, specifically North Star charts, known as capital rotation evidence, or CRE. Now, a capital rotation event isn't just some brief, everyday dip in the market. No, it is a profound period where money structurally and deliberately rotates out of one asset class and into another. Why? Because of major, fundamental shifts in investor confidence. And the data we're looking at suggests we might be sitting right in the middle of a massive rotation event, one that could easily dictate market behavior for the entire next decade.
It's incredible to realize that basically every single major financial index is currently in a bear market relative to gold. Gold is outperforming the S&P 500, it's outperforming the NASDAQ, it's beating the US dollar, the M2 money supply, and yes, even the consumer price index. When you have all of these major financial metrics losing ground to gold at the exact same time, it tells us something really important. It tells us that investors are actively preferring neutrality. They want hard assets over traditionally productive financial assets like stocks.
And listen, this isn't just some abstract theory we're talking about. It is a hard historical pattern. Consider the historical timeline. Back in the 1930s, following the massive stock market collapse, we saw a gold reevaluation where gold outperformed basically everything for 5 to 7 years. Then came the massive 1970s rotation. Driven by intense inflation, the stock market basically just went sideways for an entire decade while gold rocketed up over 2,000%. And then it happened again in the early 2000s with the dot-com bust, which sparked a decade-long commodity supercycle. The point is, these capital rotation events are historical facts, and they typically take anywhere from 5 to 10 years to fully play out.
So the absolutely crucial thing to grasp here is how this affects your actual wealth. And that brings us to real versus nominal returns. Let's just break down the math simply. Let's say you get a 10% raise at your job. Nominally, your numbers went up, right? You feel richer. But
If the cost of living, inflation, went up by 11% that exact same year, your real return is actually a negative 1%. You literally lost purchasing power. Well, the exact same thing happens in the stock market during these capital rotations. The S&P 500 might still go up nominally, but relative to inflation and scarce assets like gold, it is entirely possible for stocks to lose actual purchasing power for years at a time.
Let's move to Section 2 and see how this builds into Bitcoin and technical forces.
So if the macro environment is practically demanding hard assets right now, why on earth isn't Bitcoin soaring right alongside gold? Well, to understand that, we have to shift gears and look at the quantum mechanics of the market. Bitcoin's price action is famously chaotic, but if you zoom out, you start to see these almost simulation-like historical timing patterns. Historically, Bitcoin has consistently reached its cycle peaks in the fourth quarter of post-halving years. We saw this precise pattern play out in 2013, 2017, and 2021. Furthermore, it typically takes roughly 1,050 to 1,060 days to travel from a major cycle low to the absolute next high. And perhaps most notably, its bear markets consistently seem to kick off right around the US midterm elections and tend to last for just about 1 year.
When evaluating these cycles, technical analysts rely incredibly heavily on moving averages. The 50-week moving average acts as this crucial short-term support during a bull market. Basically, as long as the price stays above that line, the bull is happily running. But then you have the 200-week moving average, which acts as Bitcoin's long-term historical baseline. The really key takeaway from the analysis here is that once Bitcoin's price closes below that 50-week average for a few consecutive weeks, well, historically, that signals that the bull market is over and the bear market has officially begun.
And losing that support is exactly what triggers a phase that financial analyst Benjamin Callen rather dramatically refers to as a date with destiny. It's a fantastic phrase, honestly, because it describes a very real, very stubborn technical phenomenon. Historically, whenever Bitcoin definitively loses that 50-week moving average support level, the momentum inevitably shifts, and gravity just relentlessly drags the price down until it tests that much lower 200-week moving average baseline.
So where does that quantum mechanical math actually lead us today? Well, let's run the numbers. If we calculate a hypothetical drop based on previous cycles, keeping in mind that each cycle's drop tends to be slightly less severe than the last one, let's assume a 70% drop from a recent cycle peak of around $126,000. That specific math lands us squarely at $37,800. Now, while this isn't an exact science, it shows us exactly what a historically typical, technically driven Bitcoin correction looks like, and it aligns surprisingly closely with those long-term moving averages we just discussed.
Section 3. The financialization of Bitcoin.
But listen, there is another major factor at play here, a core mystery as to why Bitcoin's price feels so suppressed compared to previous cycles. The reality is, Bitcoin today is radically different from the Bitcoin of 2015 or 2018. It doesn't just trade on pure digital scarcity anymore. We now have paper Bitcoin. Wall Street has officially arrived. Bitcoin is inside ETFs, it's heavily used as collateral, it's deeply tied into some truly crazy complex derivative markets, and massive mining companies are financing their operations against it. This is, almost to the letter, exactly what happened to gold back in 2004 when paper gold ETFs were first introduced. In the short term, all of these paper products and derivatives act like a wet blanket, suppressing the true underlying price of the scarce asset.
Which leads us to this incredibly wise, if slightly sobering quote highlighted in the source. Bull markets make everyone a genius. Bear markets make fools of both bears and bulls. I absolutely love this quote. It's a stark warning. During these highly volatile transitions, you are going to see incredibly violent counter-rallies. You will see fake breakdowns and massive head-spinning market whipsaws. There will be moments where it looks like it's going straight to the moon, completely tricking the bears, followed immediately by crushing drops that completely humble the bulls. Perfect market timing in this kind of environment? It's effectively impossible.
Section 4. Surviving the wealth shift.
So, if a massive macroeconomic rotation is truly underway, how do we actually navigate it without losing our minds? This is where the source shifts away from the urge to panic sell everything and instead pragmatically advocates for a survival portfolio. Because capital rotations do not happen in a straight line, going all in on gold and abandoning literally everything else is incredibly risky. Instead, the strategy here is extreme diversification. You hold Bitcoin for its massive long-term potential, you maintain your exposure to the S&P 500 and tech stocks, you hold solid dividend stocks that actually perform well in sideways markets, and you keep enough cash on hand to avoid high-interest debt and to strategically buy assets over time.
And that brings us to our final thought for today. The global wealth rotation may very well have just started, moving us from an era of endless debt expansion into an era demanding hard, neutral assets.
But as we've seen, the path between the big picture macro reality and the chaotic day-to-day technicals is going to be pretty bumpy. So the question you really have to ask yourself after reviewing all this data is this: is your portfolio built attempting to perfectly time an entirely unpredictable rotation, or is it genuinely built to survive whatever happens next? Keep learning, keep questioning, and thank you so much for joining me for this explainer.